If you are a high income earner, this video is for you. Today, we're going to talk about the ideal order of investing, which order of priority that you should be applying your excess income to. Number one, cash. There's a couple of places that you can keep your excess cash. It's extremely important to have a sufficient emergency fund built up before we do any kind of investing. Without a proper emergency fund put off to the side, a lot of bad things can start to happen when unexpected expenses come our way. A couple of my favorite places to keep our excess cash is in high yield savings accounts and in money market mutual funds. There's a distinct difference between the two that I want to take a moment to go over. A high yield savings account is not an investment at all. You've not purchased into a mutual fund or anything related to the stock market at all. A high yield savings account is like holding money at Bank of America or Wells Fargo, and they are promising to pay you a higher than average interest rate on your cash for leaving it in their bank. Versus a money market mutual fund is actually a type of cash holding inside of a mutual fund that you would hold at a brokerage account, non-retirement investment account that is a very safe place to keep your cash. They're going to pay you a higher rate of return of interest on your money, but it's going to be sponsored on a mutual fund from somebody like Fidelity or Vanguard. CDs are something that I am not a fan of for our cash. Most of the time, CDs are very illiquid, meaning that if we need to take our money out sooner than expected, the bank's going to charge us a bunch of surrender charges and penalties to do so. Many times, if we're not paying attention to when the CD expires, the bank will automatically roll it into another CD, whether that's what we intended or not. And I find that for most folks, CDs are just not worth the hassle. We have plenty of other options to achieve similar rates of return with similar risk. Number two, 401k contributions up to our company match. The reason that this is number two on the list is because 401k contributions up to the company match ensure that we take advantage of essentially free money being put into an investment account in our name from your employer. To me, this is a no-brainer to take advantage of. Let me give you an example. If you make $100,000 a year and your company will match up to 4% of your income, up to 4% of your own contributions, if you were to put $4,000 into your 401k over the course of the year, the company is also going to match up to $4,000 into your 401k plan for that year. A lot of 401k plans match anywhere from 4% to 8%. The company match, again, it's essentially free money that we want to make sure that we take advantage of. Additionally, for high income earners, any money that we contribute pre-tax into our 401k plan is going to be an immediate reduction of our taxable income. So if we make $100,000 a year and we put $10,000 into our pre-tax 401k account, we're not only going to capitalize on that match, which is again like free money from our employer, but we automatically just brought our taxable income from $100,000 down to $90,000. So we are saving some money on taxes today as well. For those who are not familiar with ESPPs, not everyone has access to these types of plans. And if you don't, that's okay. You can go ahead and skip to number 4. But if you do have access to an ESPP plan, we highly recommend you taking advantage of this opportunity. The reason for that is that an ESPP plan is essentially an automatic discount opportunity to purchase your company's stock back from its current market price. So to give you an example of what I mean, if you work for ABC Company And the stock is currently trading on the open market at $30 a share, and your ESPP plan offers you a 15% discount on the current market price. That means that you would be able to purchase your company's stock at $25.50 a share instead of the current market price of $30 a share. The day that you purchase your stock, this is essentially an immediate gain of 15% on your investment because you're paying $25.50. The current market value is already $30 a share. An option that a lot of people take advantage of is just purchasing the stock at 15% discount, selling it immediately, capturing that 15% gain, and going and reinvesting to more diversified options like an S&P 500 index fund or a variety of different mutual funds. For this reason, the ESPP plan is in a way a form of free money from your employer, and this is why we recommend ESPP plans as number 3 on our list to take advantage of. Number 4 on our list, paying off high interest debt and credit card debt. Credit cards are an amazing tool when we use them properly. I myself personally am a huge fan of credit cards. I have all types of different credit cards for different reasons. I love earning the points and being able to go travel and buy flights for free. That being said, if we are paying any credit card interest at all, we are severely diminishing the value of those points and that free travel that we are getting. It's very important that after we've taken care of these first 3 options, we focus on paying down any credit card debt that we have or any other high interest debt. Debt can spiral out of control. It can cause us lots of problems. It can limit our future investment opportunities. It's not something that we want to have to deal with. The sooner that we can eliminate our credit card debt, the better off we're going to be. We want to get to a place where we're using our credit cards each month, but we are paying them off down to 0 each and every month. If you have some sort of a large expense that you need to cover that you can't pay off that month, consider applying for a 0% interest credit card as a way of lending money to yourself for a period of time and avoiding high interest credit card payments. Number 5, health savings accounts are a little known secret to retirement planning that a lot of people aren't aware of and don't take advantage of. If you're a savvy investor, you want to make sure that you are maxing out your opportunity for a health savings account every single year, otherwise known as an HSA. Now, not everyone is eligible for an HSA. If you're on a low deductible health insurance plan, this isn't going to be a great option for you. You might consider an FSA, which is similar to an HSA, but it's not exactly the same thing. I've got a separate article and video that I will link in the comments below for more information about FSAs and HSAs. What an HSA allows you to do is save money before tax, accumulate it inside of the account, and then withdraw the money tax-free for qualified medical expenses. This is an extremely powerful tool. It's a way for us to defer money tax-free and then spend it on things that we would likely spend it on anyways, like prescriptions, doctor's visits, unexpected surgeries, things like that. One of the other benefits of an HSA, if we don't use it throughout the year, that's okay. It can continue to accumulate year after year. And if we get enough money inside of our HSAs and we still don't need it, most health savings accounts providers offer the opportunity to actually invest that money inside of the health savings account in basic index funds and mutual funds so that you can grow the money for the future. And even with the growth later in life, having to withdraw the money for qualified medical expenses is still tax-free. Number 6, non-retirement investment savings accounts. After we've taken care of the first few things on this list, the next place that we recommend allocating your excess money to is a non-retirement investment savings account. What this means is an investment account that you can buy things like stocks, bonds, mutual funds, and index funds, but the account is not tied up in retirement account rules, meaning you are allowed to access the money prior to age 59 and a half without having to worry about penalties and taxes and things like that. So An investment savings account is a great place to set up automatic monthly contributions into to make sure that we're not accumulating too much money inside of our regular checking and savings account from our excess income, still being able to easily invest the money into the market so that it can grow, yet it's more liquid and available to us if you wanted to use that money for a down payment on a future investment real estate property, or you just needed the money for some reason in particular. It is different and more available to us than your traditional retirement accounts. Number 7, after we have started our non-retirement investment savings account and we've got a few hundred or a few $1,000s a month going into that bucket, we want to flip back to our 401k, because if we've reached this point, then we may as well go ahead and max out the benefits of the 401k, get the maximum tax deduction for the year available to us. Check that box before moving on to the next investment. In 2024, we were allowed to contribute up to $23,500 if you're under the age of 50. If you are over the age of 50 in 2024, you're able to contribute up to $30,500. A lot of people say that they are maxing out the 401k, but when they go to check their actual year-to-date contributions, they are not taking full advantage of their 401k contributions for the year. Remember, if you are making $300,000 a year and you put $30,000 into your 401k pre-tax, that is an immediate reduction of your taxable income from $300,000 to $270,000. This is a great tool to take advantage of as you're working your way up the ladder of deciding where to put your excess money. After we've maxed out our 401k contributions, we want to flip back to our non-retirement investment and savings account and increase the monthly or annual contributions that we are putting into this account. The reason for this is one of the easiest ways to make sure that we don't end up accumulating too much cash inside of our regular checking and savings accounts where we get almost no interest and income from. They're very easy to manage. And again, it's okay to save money into these accounts and keep this money here, even if you think you might want it in the not too distant future, because it is not tied up with retirement account rules. You can access this money at any time. The difference with these accounts versus retirement accounts is that we do have to pay a certain amount of taxes on these accounts from our capital gains and interest earnings. So you do want to make sure that you are using tax advantaged and tax friendly investments inside of this account. You can speak with your advisor or CPA to get suggestions about investments that are good for taxable accounts. After we've increased the savings to our non-retirement investment accounts, we want to consider a strategy that is called a backdoor Roth IRA. A backdoor Roth IRA is appropriate for people who make too much money for direct Roth IRA contributions. In 2024, this was for married couples filing jointly, making over $240,000 a year or so. If you're making below this amount, you should be able to just contribute directly into a Roth IRA. You don't need this strategy. Real quick, what a backdoor Roth IRA is it's when we make a non-deductible contribution to a traditional IRA and then immediately convert that money without investing it into the Roth IRA, then investing the money inside of the Roth IRA. For more information about backdoor Roth IRAs, I have an entirely separate video breaking down this strategy right here. Next, after considering the backdoor Roth IRA, we want to look at educational investment savings accounts for our children. If you have kids and saving for college is important to you, there's a number of different ways that we can go about this strategy. One way that we can do it is with a simple 529 college savings plan. Now, I know a lot of folks have become not so fond of these types of plans because they can only be used for educational expenses. Not everyone is confident that their child's going to go to college. I get that. I understand. But if you think that they are likely to go to college, you're just not sure, there's a lot of flexibility for what these funds can be used for, and there's nothing wrong with contributing a little bit of money into these accounts for starters. What's important is that you pay attention to not overfunding these accounts. To figure out whether you're overfunding or underfunding, speak with your advisor, speak with your CPA so they can help you run some calculations to figure out how much money you may want or need inside of these accounts in the future. If you're not fond of using the 529 savings accounts, there are some other options available to you, like cash value life insurance, UPMA accounts, UGMA accounts, and a few others that we discuss in a separate video and an article that I'm going to put a link to below. After we've taken care of all of the other investment strategies, the next thing that we recommend looking into, investment real estate. There's two main different ways to invest into real estate for regular retail investors who are working full-time W-2 income jobs. One of those ways is by buying an individual property on your own. So you're going to buy a property for an Airbnb, a long-term rental property, something like that. There are pros and cons to investing directly into investment real estate. The property has to be managed, cleaned, taken care of. We have to deal with renters and tenants and changeover, cleaning parties in between Airbnbs, things like that. But there can be some great tax and income benefits from owning the property ourselves directly. An alternative, if you don't want to mess with owning real estate yourself directly at one property at a time, you can invest into something that is called a REIT, a real estate investment trust. What a real estate investment trust is, it is a pool of real estate investments managed by a separate company like a Vanguard or a Fidelity or many other private real estate investment funds that retail investors can buy into the fund and get exposure to lots of different real estate versus buying one single individual property at a time. There are pros and cons to both of these options. Easy ways to invest inside of REITs can be offered by Vanguard and other investment companies as index funds or more complex mutual funds. Next on our list, low interest debt. We have a lot of conversations with clients about paying down their mortgages. The reason that this strategy is so far down on the list is because a lot of people that we work with are locked into mortgages and other debt that is set at these 2%, 3%, and 4% interest rates. And the deal at the end of the day here is that we just have a lot of other options to earn far more on our money than 3% and 4%. We encourage you to look into a lot of these other investment opportunities first prior to coming down and paying low interest debt down to zero. Reality is, I don't think that we're ever going to have interest rates as low as what we did in the late 2010s. It's going to be tough to have a mortgage ever that low again. So make sure you're really putting money to work in other places prior to coming back and paying down low interest debt. Now, finally, last but not least, if you are already taking care of all of the other investment opportunities that we've talked about in this video, now we're going to step into some more complex investment opportunities. And what we're talking about here is things like private equity, small business investments, private credit, and cryptocurrencies. Not to say they are good or bad, they are just complex. A lot of times they are illiquid, meaning we have much less access to our money once the investment begins. So we highly recommend people get comfortable and situated in a lot of these other investment opportunities prior to considering these more higher risk, complex investments. Thank you for joining us in this video today. Again, for more information about backdoor Roths or the mega backdoor Roth IRA strategy, we have a video attached right here that you can check out for more information. Thanks a lot. We look forward to seeing you next time.